Hello and welcome to another market analysis segment. My name is Mukarram Mawjood. I'm the founder of Bullionite, and today we're looking at a few major markets that have had a lot of volatility, but also have had some massive trending movements, right? And the important thing is we want to analyze these markets, not just talking about them and going over the fundamental events and some price levels on video. What I'd like to do is what I always do, or I try my best to do it for all of our viewers, is I'd like to do a chart segment where I'll give you the information, the fundamentals about these markets, what's going on, and then we'll switch over and analyze the actual price action and the movements in the markets, okay? And I would like to cover some major market segments, and my goal is to make sure that we cover the gold market, the silver market, crude oil, and the equities, okay? So today, I'm looking at the gold market first. Keep in mind, gold has had a massive movement in the last few months. Anyone who's been either following the gold market or investing in it, whether it's through physical gold or you have some kind of a paper contract like a GLD or an ETF, you all know that the gold market has been in a massive uptrend. It's in a big bull market. And it's also had a record high that it created just about a month or month and a half ago when it passed through its record high from 2011, okay? At that time, when I was trading the market, gold had a massive bull run from October 2008 all the way until September 2011. And the high that was created in US dollar terms was around 1,920, right? And that was in September 2011. This time around, just about a few weeks ago or a month ago, and I'll show you that on the charts, gold ran up significantly and broke through that high and went over $2,000 an ounce, okay? Now, as expected, here's what happens. I've gone over this, that when a market, record highs of markets will act as magnets, and the market will approach that, sometimes break it, and then if it gets really overbought on a weekly chart or a monthly chart, then you will see a pullback, and that's what we've seen in gold. And then after that pullback, you'll see a couple interesting things that the market will communicate to you, which is what we will go into and look at. And then what is the price looking like for gold, or what's the trend looking like for gold going forward, okay? And we'll talk about that as well. Keep in mind, this time around, there are many fundamental events that is affecting the gold market. And whereas in 2008, when gold did that move, there were pretty much two major fundamental events, right? One was the subprime mortgage crisis, and the other was the massive crash in the stock market, okay? So without taking too much of your time, let's now go into the gold chart and have a look at what the market has been doing and what you can expect it, okay? So right now, I have put the gold chart on here. Usually what I do in my videos is I give you a layout of what we're looking at first so that you understand the chart that we're looking at. First, we're looking at a daily chart, okay? So that's what the D here stands for on the top left-hand corner. And then we're looking at a gold continuous contract, okay? The gold market. And there are reasons why we want to look at a continuous contract. We don't want to look at like particular months on futures contracts because you will have different like highs and lows, but we want to look at the spot contract that is the continuous contract. Okay. The other thing is I want you to understand we're looking at a candlestick chart. You know, if you've been following my videos and how I look at the markets, I always use candlestick charts because to me, candlestick charts are the best visual representation of price action. And you have to have, if you want to be a successful trader, especially a successful trader in terms of a short-term or a medium-term time frame, you have to have an effective way of figuring out the price action. And in my opinion, candlesticks have been the best at doing that. okay? Especially if you learn certain major candlestick formation patterns, which I will cover in certain videos, or I have covered in other videos. You can always go to our site, bullionite.com, and look at that, or browse the YouTube channel and look for those videos. Okay. Now, first thing, also on this chart at the bottom, I have a couple what we call momentum indicators. So I have an RSI, which stands for Relative Strength Index, that tells me whether a market is overbought or oversold. And then I also have a stochastic index, which indicator, sorry. Both combined give me a very strong idea of whether the market is overbought or oversold. And I know there's many indicators out there, but these are the two indicators that I love when it comes to giving me a good indication of how whether a market is overbought or oversold. Now, the important thing here that I want to point out is, one, I want to make sure that everyone understands the move that we saw in gold after this massive breakout, right? So first, this particular area from March of 2020, like the middle of March, you saw that big drop in gold, right? And I have covered this in other videos. Usually this happens, like as the stock market was dropping, a lot of people ask me, well, why does gold drop? Why is gold dropping? Isn't gold supposed to go higher as the stock market's dropping? Yes, gold does go higher as the stock market drops. But there is a period of time that inside, when the stock market starts dropping initially, you'll see all sectors come down. And that's because of what we call margin-related liquidation, okay? Margin-related liquidation. And that's a simple concept where if you are over-leveraged in your stock account, or you've been trading on margin, like 2-to-1 or 3-to-1 on margin, if your stocks are coming down, most of the time, people tend to liquidate another profitable asset in order to meet their margin. So that's margin liquidation. The other reason is when you see gold going up significantly or silver going up significantly, the exchange, which is the New York Mercantile Exchange, or they will increase the margin that's necessary to hold on to a futures contract in gold or a futures contract in silver. Then there will be some people who just cannot hold on to that contract, right? So they sell off, and that's what causes the big drop. And that's normal. So don't panic when you see metals come down as the stock market's coming down initially. Usually what happens is that the equity markets or the stock markets continue lower in their bigger downtrend, and metals turn around and go up significantly, okay? Which is kind of what happened recently. Now, another interesting thing that I want to show here is gold actually started its movement higher, in the middle of 2019 towards late 2019. You can see this here. This is an area where gold was forming what I call an energy base, okay? And that's an interesting way to say it, because the way I look at it is that's a place where price spends a lot of time, and then suddenly it coils, right? Like a spring. You can see it. It takes a little time. And then it coils really tight and then blasts from there, right? So you saw probably like a $200 movement after that. That's what we call energy base. And usually you do get many areas in a chart where you have energy bases. Like for example, after this big drop right here, gold came back and then coiled up significantly. You can see that, right? Coiled, created an energy base, and then broke out another $300 to $400. Big deal, okay? So you have to learn to train your eye, okay? This is very important. Train your eyes. When you look at charts, I know that a lot of people might ask you, well, you gotta follow this analysis and that indicator and this indicator, and you can complicate things. But here's something I always tell my clients, my associates, the individuals that I train. I always say that your approach to an investment or leading up to the decision to take action, that can be complicated. I'm okay with that, right? You can do a little bit more of research. You can find out different ways of analyzing something. But when it comes to taking action, you have to have a very simple way, a simple execution plan. And that's what I teach, and I go over in different ways on how I approach that. But here's a simple way to show that. A massive energy base was built. You knew that gold is going to be strong because the US dollar continued to come down, is getting weakened by the amount of debt that we're creating. So it's an easy thing, like after you see that consolidation phase and that spring coiling really, really tight, get in. and you consider that big run, right? Now, the interesting thing here is on this run up from say around July to mid-August, I guess, right? That's such a big move, if you can see, because it just took about a month and a half to go up around $400, okay? Month and a half to go up $400. It's a big deal, okay? And on this move, you can see gold went past $2,000. You see that? 2050, it actually went to a high of very close to 2090, I think. That's why I said in the beginning of the video that we've already broken the record high from 2011, because in 2011 the record high was in the 1920s, okay, 1920, 1921. We'll look at the exact number, but this time around we've already done that. Usually markets will pull back from that record high, and that's what you're seeing with gold. It broke its record high and went to what I call an even handle. Okay, now I'm going to explain what that means. Markets usually, like magnets, will go back to their record highs. We've all seen that, right? We've seen that in the stock market, we've seen that in Tesla, we've seen that in many things, right? But another thing to keep in mind is as a market approaches an even handle or a whole number, markets tend to come back down from there, which is what the 2000 handle is for gold. It's an even handle, a big whole number. So when it broke through that, it wanted to pull back. So the way I explain this is it's okay. It's a healthy correction. I get a lot of calls, a lot of people asking me, hey Mukarram, is gold done? Is it done running? Is it over? No, because the fundamentals that's surrounding the gold trade are very strong. And therefore, all what it's doing is it's breathing. Okay, now that's a very interesting concept, right? It's because I think of these markets that break out as these monsters, right? So when a monster is in its cave and it's building its energy to come out, that's that energy phase, or the energy base that I call. Then when it comes out and goes crazy like King Kong, right? It goes crazy, which is what gold did, $300 to $400 movement in a month and a half. Then that particular monster has to rest. It has to rejuvenate itself, right? And it needs to rest and get back its energy for it to run up again. And that's what is happening now. And if you look at this daily chart again, you'll see after this drop, it looks like it's coiling up really tight, okay? Now, the best way to visualize this is to go back to a longer term chart, like a weekly or a monthly, understand that, and come back to this daily to realize how strong this coiling could be. So I'm going to do that right now. So let's switch over to a weekly chart. And there you go. So you should see the chart pop up. And this is a weekly chart on gold. I'm just going to point out, the D that we were looking at before changed into a W, which is a weekly. We're still looking at a gold continuous contract. Nothing else has changed except the fact that we're looking at a weekly time frame. Now what you'll see is at the bottom, instead of seeing just months of like data with daily candles inside of a month, you're now seeing each candle in this chart represents an entire week's worth of movement, And at the bottom, you'll see now, many months and years coming into play, right? So you now are going to see a longer time frame because you're looking at a weekly chart. And now the important thing to remember is each candle inside a weekly chart represents an entire week's worth of movement, okay? Now, here's what's interesting. You saw that big breakout that we had, and you can see when you look at a weekly chart how after this drop in March, if you look at this area in between, like after April and July, before July, you can see what we call a bull flag. You can kind of draw a flag pattern here, right? So a bull flag is a chart pattern where after a drop, you have a kind of a pole that forms when the price action. So this is the pole. See this? That's the pole. And then you have a flagging, and that's that flag. And then when it breaks through that, you had that big run up, right? So you can either call it a bull flag or you can call it a bullish pennant, okay? a bullish pennant, because it has kind of this pennant shape, and it'll have a tightening or a tapering, and it's also called a wedge pattern, right? And when the wedge breaks out to the top, then you'll have a big run. And the wedge can break down, but it didn't, because the fundamentals supported gold, right? So it broke up and had that $300 to $400 movement. And you're seeing maybe a similar kind of bullish flag or a pole forming right now. You see that? That's where we have the consolidation or the coiling happening, right? And we could be having another pennant. Now, the last pennant that formed led to a $300 to $400 movement. Could this pennant lead to another $300 to $400 movement over $2,000? Okay, it's very possible that that can happen. A lot of fundamentals are supporting that. I don't think gold is done. There's a lot more left to go in gold, which is kind of, you'll see that more on the monthly chart when we look at it. I think what it's doing, here's my opinion, right? First, we know that it pulled back from the even handle or the $2,000 handle, right? As expected. And now what it's doing is, I think it's getting comfortable above the record high from 2011. And the more comfortable it gets above the 2011 record high, and especially if it gets comfortable in the $2,000 range, watch out. Gold can have a massive move, okay? Especially because we are now coming into the election, like just 50 days out or 49 days out to election. That's a massive speculative event, right? It's got a lot of uncertainty to it, a lot of fear, lots of polarization right now in the country. And it's also the US presidential election is something that everyone watches across the world. It's not like a smaller country where they have presidential elections and that affects only a smaller group of countries. The US presidential election is a big deal, okay? And I've traded through presidential elections before, and that's why if you're in the equity markets, and if you have been fortunate enough to be part of that bounce that happened after the March drop, maybe it's time to protect your funds. It could be time to look at protecting those profits or protecting those funds and looking at markets that may have an inverse correlation to the stock market and could go up significantly, especially when dollar weakness is a theme that we're looking at, right? Now, quickly, just to look at this, I'm going to change this into a monthly chart. And when we look at a monthly chart, I want to point out a few things that should give people an idea of how much gold could go higher or what gold could do. First, when we're looking at a monthly chart, understand that is the longest time frame chart. When we're analyzing a market, we'll look at dailies, weeklies, and monthlies. Yes, there's other time frames, but the monthly, to me, is a very, very significant chart because it's very data centric. It gives you years worth of data, because if you look at the chart, you can see now it's not showing you months anymore, it's showing you years worth of data, right? And I think in this chart, there's two things to pay attention to. Number one is what happened in 2008 when the stock market collapsed in 2007. You know, just like this time in March, gold dropped as the stock market collapsed. Gold dropped, you know, early 2008 first. You see that big drop? Margin-related liquidation. Remember those words, margin-related liquidation. Then it ran up from October 2008 to September 2011, a massive, massive run, you know, 200+%, 300+% run up. Wherever you got involved is up to you how you calculate that. But it went from around $685 an ounce all the way up to $1,921 an ounce, okay? That's a big move. And it did that from October 2008 to September 2011. It didn't take that long, okay? And remember, percentage-wise, that's like 200+, 300% move, right? Now, this is the reason why, if you're looking at that chart, if you remember those numbers, gold went into a bear cycle, meaning a downward movement, right? As the stock market was going to record highs over the last few years. Then it broke out of this trend line, this what we call a downtrend line, right? Suddenly broke out, went up about 30-35%, came down, settled, and then started coiling on a monthly. Now remember this, the coiling or the energy base on a monthly will take longer than on a weekly, right? And the coiling on a weekly will take longer than a daily. But when the monthly coils and then it gets ready, and when that monster comes out, guess what it did? It went from around $1,300 gold to over $2,000 in a very short time, okay? Like you can see somewhere around like mid 2019 or late 2019 to around August 2020. I mean, in 1 year almost, right? That's a big move. Now, a lot of people ask me, has it gone up too much? First, medium term or short term, yes. But in the bigger time frame, no. There is a couple areas, like in the monthly, it needs to get a little bit more oversold. It got very overbought right here, and that's why you have a sell signal, you know, on the candlesticks that shows up very clearly, which is why it pulled back from the 2000s, right? And on the daily, it's showing you the settling down right now. But what's interesting is, first, keep this in mind. In 2008, when this big move happened, there were only two triggers, guys, just two triggers, okay? One was the subprime mortgage crisis, and the other is the equity markets collapsing and the stock market crashing. The stock market dropped more than 60%. Okay, dropped from 14,700 to 6,600 in the Dow. Okay, did what we call a Fibonacci correction. Those are the two triggers, and gold went up that much. Okay, almost 300%. This time around, in my opinion, we have 1, 2, 3, 4, 5, I think at least 5 triggers, okay? We have the big issue with the coronavirus and the economic collapse that it has caused across the world. So I talk to many business leaders, investors, clients, associates, friends across the world, and everybody in one shape or form is going through some kind of a global recession. Like every country is going through some kind of a global recession, okay? Secondly, we have a massive amount of money being printed right now, more than we printed in 2008, and more to come. And the third reason is we have the US presidential elections, right? A lot of uncertainty, a big event, a big fundamental event. Fourth reason, we have US-China trade tensions, a lot of issues. And I've talked about this in different interviews I've done, where we talked about the fact that we've never seen a consulate, a consulate from China, a Chinese consulate closed in the United States. And that just happened in Houston just a few weeks ago, right? And that's a big deal. So if you think about it, there are many fundamental factors that support the price of gold, and gold can go up significantly. The other thing is we have a massive crash in the equity markets, right? And here's what's important. I don't think anyone's ready for a post-COVID economy and how that looks when it comes to the equity markets. Yes, we had a 10,000 point drop in 1 month in March, but that may be dwarfed by what could happen going forward. Why do I say this? Very simple, right? The United States is a country. Our country is completely dependent on debt-based consumerism. Okay, I gotta say that again, okay? Debt-based consumerism. What that means is most of the time, our system or our thinking is we have to spend money that we don't have. And because of our spending, our GDP is so high. Like if you look at our GDP, a large portion of our GDP comes from retail sales. And I have a lot of negative things to say about, a debt-based economy, because I think that weakens you over time. But here's the problem. In 2008, when gold went up almost 300%, and when the markets crashed 60%, you could still go outside and spend money at a restaurant, go to a mall, Apple stores were open, everything was open. This time around, in the last 6 months or so, you couldn't spend money anywhere outside. Yes, you can spend it online, but realistically, go outside, have a look. I just came from a trip to San Diego the last weekend. Yes, people are coming to the hotels, but when I just stop, I want to get a street sense of what's going on. And I just talked to the hotel managers, I talked to different people, and they were telling me, Mukarram, during the week, it's completely dead. during the weekends are the only time that we actually open the restrooms downstairs. Can you believe that? In the United States of America, some of the biggest hotels don't even open their restrooms and on the ground floor because there's not enough people. So this could be something that when you analyze can add up significantly for a market collapse. Because when the numbers really come in, that could be big, right? Now, this is supported or validated by the moves some major billionaire investors have done. If you look at Warren Buffett, for the first time in history, he's actually bought $500 million plus of gold, of Barrick Gold, right? I know that a lot of people think that's a big deal. I don't think of buying the gold as a big deal. What I think though is the fact that he's gotten out of a lot of stocks is a big deal, okay? Especially the industries he's gotten out of, the airline industry, the banking industries. That tells you that they're worried about a bigger crash. Then if you look at Ray Dalio, who has the biggest hedge fund, Bridgewater Associates, right? A lot of money has been put into metals, into gold. So just follow, go look at this. This is what I call a street sense. Get out of your house, go to the mall. Please wear your masks, stay safe. Go to a restaurant and find out and just see the effect on the economy. And that's when you really realize what could happen to the stock market. And this is the reason why we think you can have such a big move in gold, right? One last thing I'd like to leave you with is last time when it went up about 300%, this time gold's gone up not even close to 100% yet, right? That means there's so much more movement left. And if you just look at like an Elliott wave sequence, and we'll go over that later, but pretty much you look at 3 major waves. If this is the first bull wave, the second wave is considered what's called the counter trend wave. And then if this is the third wave, usually wave 3 is equal to wave 1. Could that mean way more of a much higher movement in gold? So keep that in mind. Wave 3 usually is equal to wave 1. And wave 1 went up from 685 to 1921. Do the math. Okay, just do the math. So if wave 1 started around here, wave 3 started around, maybe 1200 or 1400, how high could gold go? Okay. As always, if you have any questions, please reach out to me or our team. You can email us at info@bullionite.com. You can come to our website, bullionite.com, or you can always leave your comments on the YouTube video. Please subscribe to the videos, and if you like the content, please hit that like button. And if you need any, if you have specific type of content that you'd like me to cover, put that in the comments section, okay? Thank you again for joining me, and happy and successful investing and trading.
Content is for educational purposes only. This is not investment advice from Bullionite LLC. There is always risk for substantial losses in investing and/or trading through any financial instrument with or without this or any other type of advertised product. Past performances are not indicative of future results. Different types of investments involve varying degrees of risk. Specific strategies or education presented by Bullionite LLC and its associates in this video are for educational purposes only.